it's because the expectations are high, right? We're always looking for low expectations going into the earnings season. We're looking for 8.6% earnings growth according to S&P Capital IQ. As you mentioned, I worked there for quite a while, so those are the numbers I'm always looking at rather than FactSet. That's a really nice number for earnings growth. But especially when you think about the GDP growth expected to be, at 2.7 is the current Atlanta Fed GDP now estimate. It all sounds really reasonable. And you might even say, hey, well, that's better than the double-digit earnings growth rate that we were expecting at the start of the fourth quarter, at the beginning of October, we were looking for 12.3%. So the near 4% pullback feels nice.
Yeah. And do you think that the GDP now number is underestimating the consumer in the way they calculate the number? I mean, it came down from 3.2% to 2.7, well, to 2.4, and now back up to 2.7. What do you think is a reasonable number? I know you're going to just be guessing like most of us, but do you have a sense that we'll come in above 3, or do you think we're going to be sub 3?
The conservative nature of me, and I'm not an economist, so yes, I'm kind of guessing, but an educated guess, I hope. I think we could come in closer to 3% because I think the consumer was, the early read is the consumer was spending this holiday season, and they were spending on discretionary items. They actually pulled back spending on non-discretionary. So I do think that the GDP number for the fourth quarter could come in better than expected. Look, the consumer has been resilient for the last several years, and I think everybody's waiting for the shoe to drop on the consumer. And I know we want to talk about the jobs report later, and I think that the fact of the matter is consumers are finding a way to make ends meet, and they're finding a way to spend. And I actually think the risk this week, Nancy, is greater in the retail sales number coming in hotter than expected than it is in the CPI data that we're going to get.
Oh, that's so interesting. Wow.
Yeah, I just expect the CPI data to kind of be in line with expectations, which are, by the way, are stagnant. When you look at core CPI at 3.3%, it's been there for several months, more than 6 months, if you kind of discount that 3.2% month that we had. You saw last week that the consumer is anticipating that inflation is going to continue to rise in the year ahead and the 5-year ahead period. So the consumer is acutely aware that food prices continue to go higher, shelter prices continue to go higher, even if there's been a little bit of a deceleration in that rate of increase. It's still there. The consumer is not comfortable with it. So they're finding ways to earn income and make money and spend it all on their own terms.
Well, and I know Arthur's going to have a question about inflation because he runs our dynamic inflation strategy and has for 15 years. But I just have one last question. So our friend Brian Reynolds at Reynolds Strategy, he looks at corporate tax receipts. I'm sure you do too. And to your point on earnings growth, they came in a little bit below the year ago period in Q4 after having, had 3 years of much higher than expected corporate tax receipts, which are obviously paid based on what earnings expectations are. So I actually think that you could be right, and that earnings they may be better than expected, but it may not be good enough, to your point. So anyway, Arthur, sorry. Just wanted to.
Well, Nancy, I was going to say, one of the things that you typically see really at year end with both the consumer and also corporate, if you think Trump's going to cut taxes next year, any expenses that corporations could have pulled from next year into this year, they did right at the end of the year. And same thing with the individuals. Like, if you can bring an expense forward and move income into next year just one day, and you can drop your tax rate on that money. I mean, people do it all the time. There's huge timing effects in fourth quarter.
That's definitely a powerful impact, and it's another good point about why the fourth quarter earnings season might not beat expectations to the historical average rate of 4.5 to 5 percentage points. So taxes are definitely top of mind and going to be key going into the year ahead, no doubt about it.
Yeah, that's a great point. It makes your point, really, Lindsay. So thank you, Arthur. Well, I'd like to know, I was reading over your notes. I feel like an anchor on CNBC. I was reading over your notes, Lindsay, and I noticed
you're doing a great job.
This seat. There's no pressure. No, but
I was going to ask a question because I don't know anything about earnings or stocks.
Go.
So I was going to try to steal your thunder, Nancy, but I'll let you go.
No, that's a first. So on the jobs market, so we have a chart, I think that you haven't had a chance to really look at it, but it shows response rates to government surveys, and they've gone down dramatically. And if we get a chance, we'll throw it up on the screen. But then you have the revision of the 818,000 job overstatement.
They overstay the number of jobs.
God.
Yes, they overstate. They've been steadily overstating them.
Which would argue that productivity has actually been better than the numbers would show. But what do you make of all this? Like, how do you base any decisions on the jobs market? I know the market does every time we get a report, but as a strategist, do you smooth it? Do you wait to see a trend that's really definitive? Like, what do we do? Oh, and there's the response rate. So you can see JOLTS is way, way down.
Yeah, these response rates, I think, and it's not just in jobs data. I think it's a lot of the economic surveys from the government have been revised in different ways because the response rates are so low. And I remember reading earlier last year an article in Barron's talking about this change, and it's because people, we're an online world, and I think the Labor Department and other parts of the government still do things the old way. But as far as analyzing this data and taking what it means from here, you can look at it so many different ways. A lot of people look at like 3-month moving averages. But to me, I like to just kind of look at where we've been over a longer term trend. I actually like to prefer to look at a chart like this and kind of surmise what it might mean, rather than just looking at one monthly data point or 3 monthly data points. I like to look at least a year's data. And one thing that I've noticed with the jobs data, you point out the JOLTS, the lower response rate. Well, the one thing about corporations is a lot of them are saying that they're excited and they're willing to hire and they're going to increase their labor force in the year ahead. And they've been saying this for some time now, and we're back to, it came down and now we're back to about year ago levels with their expectations for hiring rates. But they're saying one thing and they're doing a different thing, Nancy. The hiring rate based on real data and what they're actually doing is very low by historical standards, and actually a 3.3% hiring rate. That's more often aligned with an unemployment rate that's about double where we're at today. So hiring is very muted. Layoffs, on the other hand, are very low by historical standards. So that's a positive. And quit rates, while very low in the last month, in the month of December, they did tick up, at least in the BLS data for the monthly jobs report. I will say on the JOLTS data, which is November data, is the latest data that we have, the hiring rate, or excuse me, the quit rate actually ticked down while the number of job openings ticked up to, there you have it, 8 million jobs, right?
Wow.
And so while the job opening numbers, which most economists, and Art, you could correct me if I'm wrong, but I think most economists say that's not really the number we should care the most about. But still, the fact that they're putting more jobs on the open job boards, they're not hiring, and quit rates they went down in November, but they ticked up in this December monthly report. That makes me hopeful. To me, I've been characterizing it as this post-election labor market pop. I think companies got, pretty optimistic. When I talked to some of my recruiter friends out there, they got more optimistic post Trump's election in November. And it was an overnight change, right, is the way they'll describe it, because all of a sudden we knew what tax policy meant. All of a sudden we knew what deregulation meant, right? And so I think there's going to be a spigot opening from a hiring perspective. I think the one downside to it could be just anticipation of what AI means from a personnel perspective. And I think companies are really struggling to think their way through it, and it might hold off on some hiring. So I think TBD, but I'm optimistic about the job market in the year ahead.
Yeah, Lindsey, you wrote, I think, about the components of the last labor numbers that came out. So, I think we'd love to speak a little bit about where you see the hiring, where you don't see the hiring. Was there anything of surprise, anything that you think that's either optimistic going forward, like something we were missing again, or something that you thought was a little bit of a surprise?
Yeah, so I think this month, just like last month, so November, December, again, talking about this post-election hiring pop that I'm calling it. What we're seeing is sectors that have stalled out for several months, for much of 2024, are starting to come to life again. So you're seeing finance and professional and business services sectors hiring again. Granted, they're still lower numbers. Professional business services is a little bit better. That's engineers, consultants, administrative jobs, support roles, legal roles, all the above. Those are starting to increase. You're starting to see the jobs opening in the JOLTS report in technology tick up. So that's been a really
Wow.
weak sector, and there's potential that that could open up in the year ahead. Another sector that's really encouraging is recruiters. They're starting to hire more too in the last couple months. So that's obviously a sign that if recruiters are hiring people to recruit more, companies are hiring more. But also, it doesn't mean it's not coming at the cost of other sectors that have been our hiring stalwarts. So we've had healthcare and government. We've been able to rely on those two sectors over the course of much of this year to do the heavy lifting in the hiring and making sure that the job sector of the economy continues to chug along. And so that continues. And so there are certainly encouraging signs that we're seeing green shoots for the year ahead.
Wow, that's insightful. Yeah.
I mean, I will say, look, it's not all like rainbows and sunshine and roses, okay? So I do think, again, getting back to the limited number of response rates to some of this data, you are seeing that the number of multiple job holders is reaching levels on a per person basis above 1996 levels. So
Wow.
that's when moonlighting was all the rage. Everybody was a consultant, right? And still as a percent of the labor force, it's small, but the trend has been steadily and swiftly higher for multiple job holders. The other thing that we've seen is a switch between the number of folks and I should have sent you the chart, the number of part-time and full-time job holders. This last month in December, one of the positives was full-time jobs holders did increase, but so did part-time job holders, not as significantly as in the past. But when I look over the last 13 months, guys, 1 million jobs have been lost on the full-time front, and over 1 million jobs have been added on the part-time front. So I think that talks to a change in the dynamic and the economic forces. I think that folks are, with the job market pretty much stagnated, where companies aren't laying people off, but they're not hiring people either. And also promotions aren't necessarily happening, especially in what I call the experienced workforce level. So managers, the mid-level managers, there's not a lot of hiring. That is actually where the layoffs are happening.
Right.
So there's a lack of promotion that's a real phenomenon occurring. And I think that's partially driving some of this too. People are looking to make ends meet with higher inflation and things like that. So there's a change in dynamics. And I think that's a really good thing for the economy. I mean, Nancy, I know you talk about the mid 90s economic environment, the positives that could mean for the stock market. And I think there's a lot of trends alive and well there.
No, that's such a great point. And I think, to really try to decipher what's going on, because the numbers have been so unreliable, the government numbers, that is, the survey numbers, your anecdotal insight is really helpful also, because, I mean, as an investor, I think, the question is, okay, so then what do we do with this? Is this bullish or is it bearish? Is it good for margins? I personally think it is good for margins.